All right, I'm going to share with you an example of someone who should not do Roth conversions. I have a sneaky suspicion most of you guys are going to fall into this category. Doesn't mean Roth conversions aren't something to investigate. I'm just saying this case doesn't make any sense. All right, so I was working with this guy recently, and just like everybody's millionaire next door has been squirreling away money, doing what he's supposed to do. All right, unfortunately, like most people, he doesn't have enough in post-tax income. So everything he's got for the most part is in IRAs, soon to be IRAs, 401ks and IRAs, and that's just the nature of the beast. Stinks. He's late 50s right now. He'll probably retire 3 more years at 60. All right, he and his better half. And they're just, they're just plugging away. They've been doing that for years and years and years. So let's dive into some numbers here. Here's his income, 150. All right, so you can see he's plugging away. Look at these taxes, $28,000, $29,000, $30,000 on income 150. All right, so his expenses are $97,000. Now that's all inclusive, roughly $100,000 a year he lives on. Tax are $28,000, and when you factor in taxes, that's the money he's living on right now, plus what he's putting away in his 401k, which we've since stopped other than the match. All right, so then we fast forward till his first year retirement. He's got no income at all. So he's got no income at all the first year he retires, but he needs, his expenses are going up big time because he's going to be on the hook for health insurance, all right? So we got him paying $18,000 a year between he and his wife for health insurance. What normally was health insurance cover from work, he's going to pay on his own. I got him going on Obamacare at a clip of $1,500 a month. Now he also has $5,000 a month in just living expenses. That would be putting food on the table, gas up the car, the whole thing. All right, so that's another thing. And then he's got about another $10,000 when it comes to homeowners, property tax, and maintenance for his home. So when all said and done, he's spending about $95,000. He and his wife spending $95,000 a year. All right, plus they have a vacation goal of $10,000 a year. So their total goals, their total income needs is about $105,000. Now it's going to jump up here in just a second. So what we're going to do is we're going to spend. You can see there's no taxes here, so he's going to spend down his cash savings, and he'll be able to qualify for some Obamacare premium credits. But be that as may, I want to fast forward to 2026. He runs out of cash here because he didn't do anything other than plug away into his 401k like everybody does, and turns out that was a mistake. It's not a huge mistake, but it's a mistake nonetheless. But anyway, so now he needs $100,000 because again, healthcare inflated at 5.5%. Plus, he still has property taxes. He still's got to live, and he still got his vacation goal. So now he needs $111,000, but it costs him $125,000 for which to get $111,000 out because he's got to pay $4,000 in income tax. Now, again, one of the best tax moves he can make is get out of high tax state, move to a low tax state, which he's already done. So there you go. So we're spending $125,000 to fund $111,000 income needs, if that makes sense. Again, no income. 1, 2, 3, 4, 5, 6, 7 years of no income. Probably overestimated expenses, to be honest with you, especially the first couple of years of Obamacare. Be as may. When he's 67, he'll take his full Social Security. His income needs will drop quite a bit from his portfolio, but he'll still be there. He's still going to be calling his portfolio. So what's happening here? All right. Notice, everyone gripes about taxes. Look at that. That's the taxes you're paying right now. The highest you'll ever pay. Why? Because you have FICA, man. 7.65 to FICA plus income tax. And then when you retire, you immediately get a 7.65% tax cut. Immediately. Sorry, so hang tight. All right, so now here's his effective tax rate. What a thing of beauty here. Now, here's the years he's living off his cash. Most likely going to get Obamacare credits, but be that as it may, even if he doesn't, he's fine. He's not running out of money. But look at that, effective tax rate. Right at the 10% margin. Look at that. Now that's the effective tax rate, not the marginal tax rate. That's the effective, right? Look at that. Without doing any Roth conversions at all. So I want to show you something. This is the marginal tax rate. All right. So remember when he had an effective tax rate of basically 0, he was in the 10% tax bracket. But because he had his standard deduction and all that, it basically wiped out any income tax he owed. Remember, he still had an effective tax rate of 10%, but he's in the marginal tax rate of 25%. It's 22 now, but 25 once the Trump tax bill goes away. I hope this makes sense. So I want to show it to you again. It's critical to understand. Effective tax rate right? Let's go to marginal tax rate now. Marginal tax rate, 25%. So everyone's like, oh my goodness, shouldn't he do Roth conversions right here to get this marginal tax rate down? No, because his effective tax rate is still 10%. So why go do Roth conversions here, which will put you in a 25% marginal tax bracket when you're only paying an effective tax rate of 10% anyway? Doesn't make sense. So every single dollar he does Roth conversion here or here will be taxed at a marginal tax rate of 25%, even though he's only paying an effective tax rate of 10. Every single dollar he converts here potentially could put him up to a marginal tax rate of 25%. Don't do that. So remember, marginal tax rate means how much tax you pay on the next dollar of income. So if he did a $10,000 Roth conversions, the minimum amount he's going to pay is $2,500 in income tax because he's already in the marginal tax rate. Even though his effective tax rate is only about 12% there, because he's in a marginal tax bracket of 25%, the next dollar of Roth conversions he does, he'll pay 25% tax. And why pay 25% in tax to avoid an effective tax rate of 10% as far as the eye can see? This is when he dies, and that's the widow's tax trap. Not much, nothing to worry about. It doesn't make sense. Well, here, Josh, a 15% marginal tax bracket. Let's just say we did Roth conversions to the extent of the 15% law. So we're still paying 15 cents on the dollar to do Roth conversions for what? For the privilege of avoiding 10% well into the future, maybe 11%? That does not make sense. Don't do that. So let me show you one other thing here. Here's in 2035, he's done no Roth conversions. We're taking his 1040. He's got 82,000 of Social Security plus 58,000, which is his required distribution. All right, so we got 58,000, well, 59,000 really. 59 plus 81. So he's got $140,000 of income, 81,000 of Social Security, 59,000 of RMD. But he has 112,000 of AGI. Why? Because only 53,000 of his 81,000 is subject to income tax, of his Social Security, I say. Only 53,000 of his 82,000 of Social Security is subject to taxation. So he has 140,000 coming in because he's got 58,773 as an RMD plus 81,963 as Social Security in 2035. He's only AGI is 112. Factor in standard deductions and personal exemptions, which is what this is. His taxable income is only $77,559. He pays $10,000 tax on $140,000 of income. So I take my trusty calculator, 10 divided by 140, 7.1% effective tax rate. 7.1% effective tax rate. So to do Roth conversions at a 15 to 22 to 25% clip to avoid a 7.1% effective tax rate does not make sense. Know how the tax code works. It's not just marginal tax. Marginal tax is important for the next thing you do. It's effective tax that's important, more important though, because the effective tax is what is it you are in right now versus what will the future be for a tax perspective. And when I mean future, I mean if I do this, how much tax will I pay on my next dollar if I do XYZ versus how much tax had I pay on the entirety of my income? That's what matters, effective versus marginal. Please understand the difference. It's critical. Don't pay 25% to avoid 12%. That doesn't make any sense. No way should he do Roth conversions. No way whatsoever. All right. Love your thoughts. We'll see you.